Hi, this is Tuesday the 21st. It's about 7:20 a.m. Eastern, and this is a late weekly recap recording because yesterday I couldn't get one to show any live data, so I could only go back to last Thursday. So now market makers are at work and we have pricing done, and so we have proper curves. So this is the February trade. This trade is safe, maybe a little bit disappointing, but now we have about $45, $50 profit on the upside. It's not great, and I certainly hope the market will retrace. We still have 31 DTE, so that's about 3 weeks maximum before we close it. And if we have a look at a trade log in the last week, I did one small adjustment, and that was a short condor, 3,330.50 on the downside, and on the upside to 30.75, 31.25. That is just a minor tuning just to completely eliminate the upside risk. So this trade is safe. It's a little bit boring because there's really not much we can do to really lift the per expression line now, because as you can see, even the highest PCS we could do would yield to $2.70. And if you were to do a reverse Harvey there, I mean, first it will increase capital usage, and this late into the trade, always recommend to keep your capital usage stable to down. So what we could do is actually start the descent by balancing it with two PDS. So we start reducing capital usage. Overall capital usage for reg trades is about 84%. I think it was about $5,000 left. So at this point, I may accept a flattish to slightly positive delta for the sake of increasing the profit line. At the same time, this is not exactly consistent with the Rhino. The Rhino always keeps some negative delta. So that can certainly be done. But that would be a personal variation of the Rhino you would be comfortable with. In essence, we are going now to simplify the trade. We are going to probably start taking off the bottom part of the combo, and actually on Slack I sent a combo in the form of this one. Incidentally, it is the same for both REG and BTB, so that would be a way to reduce risk completely. If we get a small credit, and I believe it's going to be fairly flat, yeah, credit is about zero. So it would be just scaling down the trade, releasing capital for March. March is doing okay. We don't really need that capital, so there's no urgency to do that. So maybe we can wait for the market to drop a little so that at least we get some credit for it. And we can keep that combo ready, because that would also be a good protection if the market would to fall sharply, which, if you have seen the SPX outlook, is very unlikely. So at this point, it's going to be just phasing out the trade by maybe keeping some form of a wild card, in the way that if the market falls within 2 weeks, we can still make good money around the 3200 area. We are definitely at the end of the sweet spot. So of course, where the market is right now, there's very little we can expect in terms of performance. So I could understand that we would just kind of give it up on the trade and just reduce it. It will reduce a little bit of theta, but theta is minimal this far north of the tent. So this is really something that can be envisaged. Note that this would not reduce the number of strikes unless we go for -4 here, 8 and -4. That would reduce it even further, and that would be a way to really take all risk completely out of the trade. Another reason for doing nothing, at least for the next few days or week, is that, let me cancel this adjustment, is that, as you can see, the Delta Vega, and we are in low IV, Delta Vega is about 10%. So this profit line will be stable for a while, even though theta is minimal. So we can wait maybe the market to really find it difficult to go higher, and if it retraces, then we'll probably make a bit more money. Coming back to what I said earlier, for those of you who wouldn't mind going delta flattish, what's already flat, to somehow a little bit positive, and I understand that some strategies, even the RTT, allow that positive delta. And although I generally prefer waiting a bit longer, because when theta picks up, there's a Greek called charm, which actually gives you an indication on how fast your delta could be turning negative again. Most platforms don't have charm, so it's not something I'm suggesting. But what I'm saying is that if we got closer to the 10 and maybe really somewhere really closer, I mean, a sweet spot, delta will turn negative quicker. So I would understand if we were about here that it would make sense to go slightly positive because it would turn negative fairly quickly. That said, another reason to go slightly delta positive is that Vega is very low. As I've said, this ratio is about 10%, which is very stable. But if the market would drop and you are delta positive, there's little chance that volatility would make your T plus zero sink and be in trouble. So I would say that all the way to maybe a drop of 100 points, the Vega, the volatility sensitivity will not affect the trade too much. So that would be for some, even though as a mentor I'd rather stick to the guidelines and the trade philosophy, but I could understand that the current configuration may allow for some positive delta. Okay, I've been thinking aloud for too long. Let's now look at the BTB trade. The BTB trade is simpler because, as you know, there are no additional layers here. Delta is flattish. Vega is also not really important. And in this particular case, simpler management, we would start shedding part of the trade by reverse RVs. So we can maybe do, we would get what, 1.3, how much we would pay. Yeah, we could actually go for 2. It still makes a bit of money here, 55 credits, so it's not too bad. It's not too bad. We start reducing capital usage. I mean, this is a very simple, very straightforward adjustment in descent phase. So that's something that can be done. Also, I don't see there's any urgency to do that, even though, yes, theta will pick up after 30 DTE, so I can understand that if you want to get some premium out of your short condor, you shouldn't wait for too long. So that's something that I will definitely look into sometime this week. And if we look at the trade log, on the 16th, I also did the same type of short condor. It was not the same strikes, but it was 29.25, 29.75, 30.75, and 3100. So basically, we would carry on phasing out the trade slowly, de-risking the trade. I think this one has an exact 0 upper expiration line. So this one is very, very safe for about 200 points. So really nothing to worry about. Now, let's have a look at the March trade. The March trade is not doing too badly considering this mad move since early December. I think if I look at my... since we entered the trade early January, so the trade has already gone more than 100 points. So this is really not the most suitable market for a Rhino or most market neutral strategies. But so this one has been, if you look at the trade log, this one first entry not long after we started scaling in, and I have put on an extra layer on Friday, which I've explained on Slack, and I will not repeat that explanation here in this public video, but I will be happy to discuss it further for members of the class. So basically it was maybe for some an unusual way of adding a layer without really rocking the boat. I mean, the Greeks remain very, very similar. The upside risk now is only about $700, which is quite reasonable. The trade is losing a little bit, but really we have a long way to go to the sweet spot, and the trade has got a fairly good cover all the way to somewhere in the tent. Um, and of course, we would start peeling off and rolling back if the market would fall abruptly below the lowest short. So this trade is fairly safe. We just have to let it grow. We understand that the trade is now towards the end of its initial phase, around 56 to 5049 DTE. It will turn into what is called generally the cruising altitude, and this trade is not badly positioned. It is not the best environment to make a lot of money because we paid more than we would have liked to for our combos. The first combos were at a reasonable price, but the scaling was less attractive. So, and even this last layer was not very attractively priced. But I think we have a good-looking position right now. Sadly, when market grinds up and volatility comes down, theta comes down as well, and it's more difficult to get to a delta level where we would adjust with the standard call calendar upside hedge. Those hedges haven't been used often in the last probably year or two because of this very strange environment. Basically, the rhino will behave in its most normal way if after scaling in or even without scaling into full size, the market stays somewhere north of the combo, but well within the sweet spots, so where the delta can grow up nicely. This grinding up market, relentless rise of the SPX is not a favorable environment for the rhino to build up its delta. So now hopefully it will pause and congest here and maybe even come closer to the tent. So as I said, probably somewhere in the sweet spot where now that also that we have an extra layer, it will have more theta and its delta would actually grow faster. Otherwise, if it doesn't, but luckily again, we have still followed the market with that extra structure up there. So unless the market now shoots to 3,400 or more, uh, we may reach if I look at maybe, let's say in 2 weeks' time, 3 weeks' time, let's say about 3 weeks' time, as you can see, now the delta would still be very, very flat. So this means that after we've added a layer like this, there's virtually no chance of reaching a level where an upside hedge would be warranted. Now, lastly, let's look at the B2B one. The B2B, again, closer to the guidelines. This one doesn't have much negative delta, so it's not suffering too much, but we are a bit at a loss because basically here, either we wait, and fortunately theta is still positive, if they were still around the sweet spot. So if the market would hang around this area, we could let delta build up. But if we look at again in 3 weeks' time, delta would still be reasonable. So below hedging point. So this means that if the market stays there and still has a risk of going further up, this trade would become a little bit too risky. Not very risky, if we remember how the rhino behaved in the 2017, which is grinding, low IV, actually even much lower IV than today. We used to pay a lot more. I mean, this about $1,800 upside risk for five broken butterflies is still a reasonable risk to take. At the same time, if the market doesn't show any potential to let delta build up for an upside hedge, either we would need to change the rules of the rhino and apply a preemptive hedge. That's also something that is possible, and that would be part of a variation, but that is not the rhino as it is now. Otherwise, we are left with only one option, that is applying PCSs and maybe even reducing the trade by applying an RTT mutation right away. This is something that at the end of this growth phase, if the market doesn't go further closer to the tent, I would say in a thicker part of the sweet spot, that is a decision that will definitely be made. And that would be, for example, a reverse Harvey here, so basically a PCS on upper longs, balance for capital control. And we would do that gradually. We can also, of course, go for those who want to be more conservative, assuming that the market will keep going up and up without looking back. Then we could also, of course, do a more sizable reverse Harvey, or I would say a decisive mutation towards RTT. Right, that's it for now. For just a couple of trades where there's not much to talk about. Let's say this weekly recap has been mostly thinking aloud about how I feel about the trades. Realistically, there's no urgency, no need to act quickly. We are probably going to wait for another few days to see whether, as earnings season is coming in, maybe we will have some reaction. That said, it is very much likely that buyers will keep filling the dips unless we really break the 3300, or I think there's another support, another 3270, so 3280 area. It is likely that even in the case of some mild profit taking, there will be actually very little to do. All I'm saying is that the RTT, in essence, always tries and reduce the upside risk as quickly as possible to the extent that you can go delta positive. In the Rhino, the mutation is more gradual, and we keep some negative delta all the way. This would be actually a fairly large delta reduction, so I don't think there's any reason to do that right now. So we would probably just go for this one, just reducing a little bit of delta without changing the dynamics of the trade. Okay, that's it for now. I've been talking too much, and again, for a situation where there's actually little to do. So I will see you later on Slack, and there are no adjustments. We've adjusted most trades one by one last week. Again, there's probably no need to adjust anytime soon. Okay, thanks for watching, and bye for now.